Hey guys, welcome to this week's Money and Investing Show. This week we're tackling the subject, or myth busting the subject, of 5 of the biggest misbeliefs in the stock market. You're going to be blown away when you start to see as we unravel how deeply held some of these misbeliefs are and how they stop people actually getting ahead and achieving what they deserve in life, purely and simply because their belief system is based on something that is wrong. I know you're going to enjoy the show. It's certainly going to be contentious. We'll see you in there. Hey there guys, welcome to this week's Money and Investing Show with me, your host Andrew Baxter, and as always my offsider, Mr. Mitchell Laurential.
Thank you, Mr. Baxter, and it's a pleasure to be your offsider today. I'm going to need your expertise because there's something I need to cover here. That is the 5 biggest stock market myths debunked.
Oh, this could be fun.
I know.
I wonder what they are. This is going to be a cracker.
Now, you and I hear this stuff all the time, new clients, this, that, whatever. But the fact is, a lot of it's not true.
That's right, there are a lot of misbeliefs about most things in life, and people are so dyed in the wool with those misbeliefs because they've heard them for such a long time.
Sure.
I think Christopher Columbus said the world was round and everyone laughed at him because the misbelief at the time was that it was flat. Had he not have done it, we wouldn't have discovered America, we wouldn't have an orange president that likes Twitter, and the world would be a very different place.
Well, funnily enough, there's still those flat earth society people that believe in that. But parking that to the side for a second, let's kick it off. Let's get straight into it. This is going to be a really fun podcast. And look, obviously you've had 27 plus years experience, so let's get your real life take on some of these myths.
Okay, I'm excited. What have you got? I'm nervous too. What have we got?
Number 1, investing is like gambling. True or false?
Yeah, no, I'd probably say it's false.
I'd hope so.
But for a lot of people it becomes true, and here's why. If you think about gambling, you put down a stake, and if you're right, you get a return on that stake, and if you're wrong, you lose all your money.
Sure.
And for some people that aren't educated, I think trading and investing can be like that. If they get it wrong, because they don't understand risk management, they run the risk of losing their money. For our clients, and we really pride ourselves on the amount of schooling that we put in on risk management, whether that's using stops, whether it's using put options for protection and various other things in there. Yeah, your downside risk is actually contained to a relatively small amount. So your downside is pretty negligible. Your upside is really not fixed either. And again, that's the difference with gambling. If the odds are 3 to 1, you get 3 times your stake, or
Sure.
you lose your stake. In trading, well, who knows what your upside is going to be? You can't determine that in advance, and we did that with some of our strategies, of course, but your downside's also covered. So add then into the fact that by using some solid analysis, you're able to sort of tilt the odds, if you will, in your favor. You're definitely not on the punt. You're actually constructing a pretty well-shaped view, and you're mitigating risk on the way. So no, trading and investing the way that we teach and the way that we do, definitely not gambling.
Well, look, thank you very much. That makes a lot of sense. And I guess even putting it in one of the worst perspectives, you could take AMP, for example. I mean, here's a stock that's down 77% over the last 10 years. It's not gambling because their money's still not zero.
No, and it's only down 77% if you're one of those people that have...
no stop loss.
Yeah, if you don't have a stop, or if you've chosen to realise that. If you hold on and hope it's going to come back up, well, that is a bit of a hit, and I hope that's like backing the 250 to 1 outsider that's drawn the 13th barrier on the racecourse. It's unlikely to come back. But no, it is a huge myth. People do see trading and investing as being gambling. It genuinely isn't, in that you can contain the risk, but more importantly, you can tilt the deck by doing your homework and really learning what you're about. If you're going into it totally blind, see this all the time, you know what it's like in the broking business. People will open an account, put 5 or 10 grand in, so I'll give it a go and see what happens, and I'll tell you what happens, they lose their 5 or 10 grand. So
Sure.
people that do that, definitely a gamble. Best investment you'll make is in your education before you start, so that you're not gambling.
There you go. Investing in the stock market, that is false, that it is gambling. Let's take it to a really interesting one. I know you had this comment on Facebook, and I just heard it as I walked past the hallway before, that short selling drives the price down. Now, first of all, what is short selling to our viewers who don't know, and does it drive the price down on a stock?
Again, it's interesting, big misbelief out there. I was told the other day, short selling should be banned, it's evil. And it's like, well, why do you think that? And they're unable to come up with a response. So what is short selling? Short selling is something that you do not own. And I know that sounds a bit of a spin out in terms of context and concept. So what you do is borrow something you don't own from somebody, and then you sell it at a high price, and your goal and your view is that you expect prices to fall. And if that is the case, you get the opportunity to sell it at X, buy it back at Y, the lower price, and the difference between X and Y is your profit. In just the same way, if you bought something that goes up in value, you participate in that profit.
So you're betting on it going down in price?
Well, you're not really betting on it. We've just covered that, I think.
Sorry.
No, I think yes, you're taking the view, let's call it that. We're taking the view that the price is going to go down, and you're looking to capitalise on it by setting yourself up.
Trick question.
With a smart strategy called shorting. Now, one of the misbeliefs out there, and look, there's a little bit more in there. Think about it this way. All right, let's put this in really simple terms. Let's say I'm having a party at my house. It's Good Friday. There's no bottle shops open, no pubs open, and I run out of beer. Now I'm going to lean over the fence to my neighbour, being you, and say, Mitch, can I borrow a couple of slabs of beer? We've run out over here. You pass it over the fence, and then, given how charitable I am, I'll then sell those beers on at $10 a beer to my guests, and so that 24 slab of beers earned me $240 in revenue. That's what I've sold it for, $240.
Sure.
Now on Saturday, Dan Murphy is going to be open, so I'm going to swing over there and get a couple of cases of beer to replace the ones I borrowed from you. Now if I buy them back at $60 a slab, and give you 2 cases of beer back, you don't care that I paid $60 a slab for them. You just want what I borrowed back and intact, and there's probably a little bit of a dial-up and a fee for you in doing that. Now, from my perspective, I've been able to sell a case of beer at $10 a bottle, $240 for a case, and then buy it back for $60, squaring the trade. So there's a different way of thinking about short selling. Most people know about beer, so it's probably quite a reasonable example. Now, why doesn't it drive markets down? And this is the key point. People think that in times of crisis, that when people that are pro traders short the market, it pushes prices down, and that is just simply not true, and here's why. Short selling, the ability to profit in a falling market, enables groups in the market, like a market maker and people in the options market, to be able to offset their risk. So if you can profit from a fall in the share price, you're going to short sell, and in doing that, to square things out, and this might sound a little bit confusing for people that are new to this, you also have the ability to then create a put option where you can sell someone insurance on their shares. Now, you might buy a put option, it protects your shares at that level. If the price goes down, I have to buy them at that high price, they're worth less.
Sure.
So as someone that issues a put option, I want to bet a short, so I've actually hedged my position out here.
So it's like the reverse covered call, which is what we specialise our teaching in.
Now, if I'm not able to short sell, I'm not also able to create a put option in the marketplace, and as a result, you then have no ability to protect your shares. And in times of crisis, if you can't protect them, you're going to sell them.
Sure.
And as soon as you go to sell them, it's going to push the price down. So it's such a massive misbelief. Short selling does not push prices down. It actually helps support the market. Now, ASIC actually banned short selling during the GFC, and all it actually ended up doing was pushing the market sell down much, much harder, because people that are pro traders and people that are savvy investors had no ability to hedge. So their only thing to do is go sell the lot, push the price down. So shorting doesn't push markets down, it actually does the reverse.
There you go, nice and debunked. Thank you very much, Mr. B. Now, third one here, this is, we've got a couple of case studies. I've done my research on this. Investing in IPOs makes you rich. True or false?
Can do. if there's one thing, I guess if I was to describe IPO investing, I think we've covered this in a previous podcast.
It's one of our earlier podcasts, I think around that sort of 5 or 6 mark in terms of episodes.
Be interested to go back and have a listen to that one.
It would.
I think IPO investing, out of virtually anything you can do in the stock market, is very much a gamble. And part of the reason for that is that you are having the price dictated to you by the company that's listing, and of course the investment banks and sponsoring brokers that are underwriting the listing or the IPO.
And as much as they're quite analysis focused, there's still a decent level of bias in that. Would I be correct?
I think that will be a fair and cynical comment to make, because they have a very vested interest in getting the best deal for their client, which is the highest price.
Sure.
Which may or may not be in the best interest of the consumer.
Sure.
And there are plenty of examples of that. Now, IPOs, when they work out, can be absolutely fantastic. And IPOs, when they don't work out, can be an absolute disaster. And last year, there were plenty, and I think we've talked about them in the past. If we look at Uber, I think Uber is down something like 61% from its IPO right now.
Correct.
Lyft, another one in the same business, I think it's down not as much, about 30-35%, something in that sort of ballpark since its IPO. Elsewhere in there, Luckin Coffee is a stock we've traded actually a few times, very profitable when we traded it. That's a dog's breakfast. It's down 93%. It's actually
terrible.
93% from its IPO price of $20, about $50, $60, something like that now. And look, it's been a fraud within the business on the part of the CEO and CFO. But you look at what you were buying as an IPO investor, it's very much not what you've got. So there are 3 really distinct examples of things that haven't panned out. On the other side of the coin, if we look at Saudi Aramco as the world's largest IPO, that one's actually worked out pretty well. I think it came on at about $20, and there was a bit of a dip as oil prices caved in, and it's now back above its IPO level.
Well, there you go.
But you're in the lap of the gods with that. Another one that was a bit shaky for some of the people riding on it, no pun intended, and that was Peloton over in the US. Peloton's a really interesting business, actually. I first came across them in New York. I was staying one of my best mates' place up on the Upper West there, just overlooking Central Park.
Beautiful.
Lovely pad. You wouldn't want to pay for it, but it's a beautiful spot. And downstairs and across there's a Peloton, and it's actually like a spin class type gym. All you do there is cycle, and that was my first experience with Peloton. And they listed, why are you going to list a company that just does spin classes? But what they've been able to do is they also sell the exercise bikes, and that's effectively what the business is. But again, you look at it and go, yeah, I don't really understand where the ongoing revenue is coming from. And where Peloton has really done very, very well, during COVID, obviously people can't go to the gym, so they've been selling bikes. But what they've created is that online community so you can register for classes and challenges where you're actually competing with other people.
Which is super scalable and very cost effective.
Massively so, and the share prices reflected that. It's actually turned out to be an absolute champ. It was down 11% day after it IPO'd, and most people are looking at it and going, geez, not another one. And if you've stuck to your guns with that one and held in there, it's turned out to be very, very good. Great business because they've leveraged off their core skill and just perfect business in the COVID environment. That's why it's done so well. So, there've been some big winners in there.
Sure.
But, we've just talked about 5 or 6 IPOs and 3 of them didn't work. So, there's your 50-50 or so odds. Yeah, definitely gambling in my mind.
So you think it's a little bit more of a speculative play when you're investing in IPOs?
Absolutely, because you aren't making the decision and neither is the market in terms of where fair value is. It's being dictated to you, whereas with something that's traded for a period of time, you can see where the market has genuinely assessed its value, and then you can take a position based on your analysis around that. A lot more robust.
Just out of interest, how do you pick a good IPO? I know we could go way off topic on this, but just quickly for the viewers out there who might be interested in IPOs, what kind of analysis do you use to choose an IPO?
For anything that I've ever invested in, actually two of my really good investments when I was a kid, one was in a demutualization and an IPO, and that actually was my first 5-bagger, 500% return.
Wow.
So maybe I should have just stuck to doing that. The key things that you look for, again, we go back to this litmus test, which we've talked of several times in recent podcasts, and that's, where does this business fit in the future? And Peloton's a really good example of that, from a business that's just a gym-centric business, where they've taken a physical presence and then created this virtual presence and community to support that. So it's a very forward-looking business. You'd argue that companies like Uber and Lyft are also very forward-looking businesses. They've disrupted the technology in the sectors they're in, but they're not able to turn a profit from that. So you've got to have that ability to create profit. Now, when you look at an IPO, you look at the offer document and all the details that go alongside it. But that's written by the company and its investment bankers, and typically it's going to project a pretty strong story.
Sure.
Whether that story is right is another matter. And if we take WeWork as an example of that, that would have gone down ultimately, I think, as one of the biggest corporate frauds in history, had SoftBank not pulled the IPO for very good reason, and that's the fact that the emperor had no clothes. There was no business behind it, there was no real cash flow, there was no plan on what to do with the money. Yet anyone reading the prospectus with a view to investing in it could have really been taken to the cleaners, and that's where the regulator's got to play a very, very strong hand in making sure that what the company says it's going to do is indeed what it does.
Right, okay, well there you have it. Thank you very much, Mr. B. Fourth one. You need lots of money to invest in the stock market. Is that true or false?
No, not at all. You don't need lots of money, you just need to start. People think that the stock market is, I guess, for the big end of town and the big instos, and having a smaller amount of money to work with can actually be something of an advantage. If you're running big portfolios, got a couple of buddies that run multi-billion-dollar portfolios.
Stressful job.
It is, and getting in and out of positions is hard work because you move the market just simply by virtue of your size. So if you're trying to sell, you end up selling into a falling market. It becomes quite tricky. As a smaller investor, it's much easier, you're more nimble, you can get in, you can typically get better fills and so on and so forth. And these days, getting started with 5-10 grand is a realistic proposition. In the past, you think about brokerage, for example, 1% or $85, and there's still people that charge that, believe it or not.
It's a fair whack.
It is a fair whack, and if you're a small account, you just can't absorb a position and cover your brokerage and come out of it making a profit.
Sure.
So lower transaction fees have paved the way to better start with smaller amounts of money. Again, if you're looking to get started, doesn't matter what you've got, get started. Just get started. Obviously, you can't start with $20. Let's get real about this. 5 to 10 is probably a good number. 5 to 10,000 is a good number. Let's plant the flag at $7 grand just to pick a number that we can talk to.
Yeah.
And get yourself started with that. And if you don't have that number yet, get yourself educated so that when you do get the money, you know what to do with it. Because if you don't get educated, even if you have the money, you're likely to do something fairly frivolous. You might end up putting it in an IPO like WeWork or Luckin, and it's all gone. So get yourself educated with that as well. But you can start small and get it building. I think my first investment was a couple of £100. That's all I had saved up at the time. And I dusted that pretty quickly because I didn't know what I was doing.
You're only 3 years old when you made that first trade, then, weren't you?
No, a little bit older than that. Maybe 3 years older than dog years. But I think the second time around, I had a little bit more firepower to work with, and I think I ended up getting started. I think it was about $5,000 or something like that.
There you go.
What I started out with, and kicked off with that. So it's definitely doable.
Sure.
But we put up these stories of when I get that amount of money, I'll start. Just start, then you'll get that money. If
Exactly.
you put that goal, it's out of reach. It's not going to happen.
Sure, and we have a whole, for example, our ETF program, which is perfect for smaller account sizes that maybe won't be super hands-on.
Well, that's the thing. At the moment, with interest rates being so low, there's almost no incentive to save cash at the bank. Okay, you need some cash to cover your bills, but there's no point having cash as a form of investment. So get it stuck up an ETF of some sort, get invested in the Qs in the NASDAQ, for example, and just forget it and just let it sit there for a period of time growing for you, because that's probably a smarter thing, I think, to do with your money. It's not a gamble. Technology is going to be a bigger part of the future than smaller, and getting some exposure to that, for example, would be the advice I'd give my kids rather than putting money in the bank.
Well, there you go. That ties in a few of those myths, so thank you for that, Andrew. Last and final one. We may have a bonus one at the end. I'm not too sure yet. But the last one, the whole notion of making money in the stock market is to buy low, sell high, turn water into wine. Is that how it works?
No.
No.
It's a lovely story, though, isn't it? And this notion of picking the bottoms and
selling at the tops.
Yeah, no one does that on any level of consistent basis. You might do it once or twice, and you've got a great war story for your friends. But the reality is, to be able to do that on a very consistent basis is not impossible. The challenge that you have trying to buy low is that you're buying something that, say, for example, has fallen, through the COVID scenario. You've had a market that's dropped pretty heavily, and if you're trying to get in on the ding dong low, and we actually weren't far off it, in all fairness.
Right.
You're guessing that actually is the bottom. You're taking the gamble, if we go back to some of the other things that we talked about, that's the actual bottom of the market. Personally speaking, I would prefer to see much more confirmation. Not we leave it months to decide, but wait to see it coming off its lows and start to power ahead. Look for that money flow coming in.
And we use technical indicators to justify
exactly
that,
right. So that's how, to avoid gambling and guessing that's the low, we're using a series of screens and strategies to ensure that we're buying into momentum. Very, very important.
Sure.
But this notion of buying low and selling high, take the easy money out of the middle. Or better yet, buy high and sell higher.
There you go.
Or buy at a price and sell for the same price and still make money. That's what we use covered calls and cash flow on demand. I bought ANZ for $18 and sold it for $18 and made 9%. That's the joy of using options. The share price doesn't have to move in order for you to be able to make your money. So, buy low, sell high. Great story, great cover for a book, great way to try and sell a course. Or we've got this proprietary measure that does it. It's all BS. It doesn't work on a consistent basis. Get in when the momentum's happening. Don't leave it too late. Have a plan to take the emotion out of it. Definitely don't gamble. Make sure it's not an IPO. Type just get in there, and in you go. But no, buy low and sell high. That's a myth.
That's a myth.
It's too hard to do.
All right, debunked.
You can be a ninja at it. And I've got some good buddies, really serious players in the market. These guys are wheeling around billions of dollars in the marketplace, and they can't do that. And
Well, there you go.
Teams of analysts, every bit of software known to man. They stack the deck. They play the safe odds, take the easy money out of the middle.
There you go. Debunked. You heard it here first. Thank you, Mr. B. And the last one, the final bonus one. I know we briefly touched on this before.
What have we got for me? These are always tricky, Mitch. What are you going to do to me here?
The stock market is only for big boys on Wall Street. Now, we don't have any Wall Street clients in our client base, yet we've helped thousands of everyday Australians. So working that as a contrast, specifically related to, let's just take us as a proxy. Why do our clients get the results that they do when they're not these big boys on Wall Street?
I think the key thing is strategy selection. And people talk about Wall Street. What exactly does Wall Street mean? Is it hedge funds? Well, they're unlikely to be on Wall Street. They're probably out in Connecticut or up on Long Island rather than Wall Street. But Wall Street is a connotation of the investment banking space.
Yeah.
And they're looking for stock markets to move up. Most of the time, these big guys now are running quant desks and algo trading and all of this fancy stuff. That's new age finance, which is crushing it in markets. Do you have to be there to do that? No, you don't. You just got to find a strategy that fits you. And people always like to chase the wind or the allure of outperforming something. Success is not relative, it's absolute. and you could go, well, relative to someone I've outperformed, but you might be unhappy in it yourself. It's how you feel about your returns, whether that based on what you're looking to achieve from a risk perspective.
Sure.
If you're a low risk investor and you say, look, I hate risk, and you're pulling down 8% a year, that's a brilliant return
Right.
for a low risk investor. For a lot of people, go, I wouldn't be interested in 8%. Well, clearly to get that, you're going to have to move up the risk spectrum some.
Sure.
To pull down 73% in 1 month, like Mark James, one of our clients, you go, wow, he must be taking some big chances. Not at all. He was very measured and controlled in what he did. He's called the market very, very well using what we've taught him. So he's going to be further along the risk spectrum, bigger return there as well, but not way off the reservation taking big chances. So let's bring it back in and talk about absolute return that's right for people. The key thing is to pick the right strategy. And there's so many different strategies available in the marketplace now. You can talk about CFDs, you can talk about E-minis, you can talk about day trading, you can talk about crypto, you can talk about Forex, you can talk about margin Forex, you can talk about futures, stocks,
the list goes
ETFs, geared ETFs, options,
Swaps.
warrants, swaps, LIPOs. There's a myriad of different things that you can trade. And rather than try and compete with Wall Street, find your groove in there in terms of the kind of asset or strategy that's going to deliver what you want. Now, for most people, they're looking, if we had a normal distribution curve, a nice little whiteboard, and get something like that, some AV props in here. What do you think?
Why not?
We've got a good month. We should do it.
We'll have to ask our production manager.
See what we can do. So, if we had a normal distribution curve, most people will be looking for something that sits somewhere in the middle that's got enough risk in it to be interesting, but not enough risk to keep you up at night.
Sure.
And something that's paying out fairly reasonably. So for me, my meat and potato strategy that I drive people to in that space is covered calls, cash on demand as we call it. And if we think about it, it's like the ice cream van of trading. It serves a brilliant soft scoop on a really consistent basis with fairly low levels of risk and very consistent income, which ticks a lot of boxes
Makes
for
sense.
people, right? But it's an ice cream van, and it serves up vanilla ice cream, and if you're lucky, there might be a flake or maybe a little raspberry sauce or something if you're really lucky. If you're looking for returns outside of that, you've got to go to different strategies. Okay, if you're looking at returns beyond that or below that, you've got to look at different strategies. So it starts with actually what your strategy selection is, and most Wall Street banks aren't involved in the covered call space. It's more typically a retail strategy. I saw some advertising from someone that's supposed to be a competitor of ours. I don't think it'll be around much longer, but and it's sort of, this is the strategy that the big banks use with your money. It's utter rubbish. They don't use this strategy.
What strategy is it?
The sort of stuff that prop desks do is not covered calls. Okay, this is a mum and dad strategy that's a terrific income producing strategy. So, that's where our focus will be there. Now, if you want to get into a highly complex algorithmic trading in and out in milliseconds, that's where you're going to go to compete with Wall Street. It's not the game you want to be in.
No.
You know, a pretty decent internet plan, probably not on the NBN.
Rent a unit just above the exchange somewhere in Sydney.
Yeah, that's exactly. They've got their data terminals and all that in there. So, Wall Street's got its own game that it's playing. Okay, and it's in such a myriad of financial instruments. So, for retail investors, don't go to that place. You can, they're inaccessible for you to trade anyway, high frequency trade, all that sort of stuff. That's not for retail investors. Find a nice strategy that serves your purpose, that weighs up risk versus return, plus how much time do you want to put into this too. There's some people out there peddling day trading. I can't, and I've done it, I did it for a living for a while. I can't for the life of me think why you'd want to day trade.
We did a whole podcast on it.
How many people, what was the percentage of people that are successful?
99% fail or something like that.
So 1% succeed as day traders. So, that's another place that you can kind of go to and you think, well, this is my thing. Just find what works for you, time-wise, risk-wise, and return-wise, and where that sort of trifecta comes together. Interesting, we're talking about trifecta, having been talking about gambling earlier. Where that trifecta comes together is probably where you need to drop anchor. And don't obsess about trying to outperform somebody else and have performances relative. Just be absolute from what you're aiming for and say, look, if I can make 10, 12, 15, 20% of my money consistently, or 30% of my money consistently, or 6% consistently of my money, that's my space. And just focus on that. You don't need to be distracted by anybody else. So, in terms of trading and investing is just for Wall Street. No, it's for everybody. It's a big place to go play. You just got to choose the strategy that's going to work best for you, because if you can operate and dominate your strategy in your sector, you'll make great money. If you pop up in somebody else's sector, a la in the Wall Street space, and try and play with those guys, they will wipe the floor with you.
Yeah.
You won't even know what happened. You'll be sliced, diced, cryovaced and out the door before it even happened.
There you go. Look, that is really, really good advice, and we cannot stress that enough, to carve your niche and just focus on what you're doing. And having a trading plan to that is paramount. Andrew, we've covered off 5 really, really important myths that a lot of people misconstrue through the stock market. We've also had that quite nice and informative bonus one. We're coming to the end of the broadcast. Is there any final words, overarching, which pertain to myths of the stock market and how to beat those?
That's an interesting one, really. I think for me, be open. There are so many misbeliefs out there, and you can listen to so many pundits and talking heads. Check out their track record, find out if they've been around, find out if they're licensed, find out what they actually know. There's one popped up on my feed the other day. They've been around since March of this year. It's 2 young guys. Good luck to them. They've built a good following, but what do they really know?
Sure.
What experience? What have they done? So firstly, find someone that's listen to the right people. And I'm not saying that we're necessarily the right people, but we try and call it as it is in a pretty straight manner. Second to that, there are so many misbeliefs, and just because you've heard something over and over again, it doesn't mean it's right.
Sure.
Buy and hold shares for the long term, best way to make money. Well, we've debunked that myth many times in podcasts and some of the material that we've put out. Buying stocks for dividend is a great income way. The misbelief, short selling, as we've talked about today, drives markets down. It's a misbelief, it's incorrect. And if your whole decision-making process, what you and our listeners are going to do with their money, if that's guided by something that is just wrong, you're not going to get the outcome you want. And it doesn't matter how dyed in the wool you are of that belief. If it's wrong, it is wrong, and it's not going to serve you. So what I would say as a parting message for anybody is be open. Have a look and actually do proper research and find out what's true, what's false. What is a genuine belief that should be held versus a misbelief that not only is misleading, is one that's likely to cost you thousands, tens of thousands, millions of dollars over the course of your lifetime. And some people won't even entertain investing in the stock market because they see it as gambling. We've dealt with that today. And imagine if you went through your entire life where you missed the opportunity that this great thing called the market creates because of a misbelief that it's actually gambling. Be open, get educated, team up with the right people, and give it a go. And you'll be amazed where it's going to take you. Or stay in the bubble, be driven by misbeliefs, be frightened of your own shadow, and wonder why everyone else is getting ahead.
Some great advice. Thank you very much, Andrew. And it's a fun place. When you get the hang of it, you and I love it. I mean, it's what we live and breathe.
Certainly, it's day in, day out.
Absolutely. Look, thank you very much, Mr. Baxter. I think we're going to have to contact the Discovery Channel and see if we can get a revamp of Mythbusters, but keep an eye on there. But look, it's been really good to get your take, and there's some great advice as well as debunking, some costly mistakes that could be made if you follow, some of those points.
I'm just imagining you in the beret on Mythbusters. I think that's all. Good on you.
Start growing a beard with some glasses on, and maybe I'll sit at the park.
Could be fun, couldn't it? Look, thanks for having me on today. Pleasure to spend some time with you.
Cheers, thank you.
There you go, guys. Hope you enjoyed the show. Make sure you give us a review and rating, and we'll look forward to hosting you next week.